Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
We all want the truth. What we actually want is the truth that agrees with us, delivered with a smile. This meeting could have been an email. The email could have been nothing. We chose a meeting. Hard work never killed anybody, but why take the chance? We're pivoting. We tried the thing. The thing didn't work. We need more of your money. Growth at all costs is a strategy. So is jumping off a building. Both involve descents you didn't fully plan for.
Copper futures are now flirting with $6.50 a pound, up from nearly $3.6 a pound in mid-2023. That's not a rally anymore, that's copper applying for tech stock status. Markets are suddenly pricing in an electrification supercycle. EVs, AI data centers, power grids and defense. Spending all want the same reddish-orange metal. Problem is, mines takes years to build and demand is arriving like it skipped the queue. For central banks hoping goods inflation stays quiet, copper just sent a strongly worded email. Tech now makes up 55% of all US business investment, up from just 15% in the 1960s. America did not deindustrialize, it just replaced smokestacks with semiconductors and factory floors with data centers. Today's capital spending isn't just about machines anymore. It's AI chips, cloud infrastructure, software and enough GPUs to make the electricity grid nervous. Silicon Valley has basically become America's modern industrial policy with better hoodies. The risk, when one sector becomes this dominant, every market cycle starts looking like a tech earnings call. The largest sovereign wealth funds now control trillions of dollars, with Norway's oil fund alone sitting on roughly $1.7 to $2 trillion. That's not a rainy day fund anymore, that's we accidentally bought half the stock market territory. The list is dominated by oil exporters and Asian financial hubs. Norway, China, Abu Dhabi, Saudi Arabia, Singapore, Qatar. Translation, commodity booms and trade surpluses are quietly being converted into global influence. These funds now own slices of airports, tech firms, real estate, infrastructure, basically the modern global economy with a diversified portfolio attached. And increasingly geopolitics and investing are becoming the same conversation, wearing different suits. India's private consumption growth has slowed to roughly 10.4% since FY18, the weakest stretch on record, after averaging nearly 15% between FY 2006 and FY 2014. But this looks less like collapse, and more like a consumer stuck in traffic after a decade of economic speed bumps. Demonetization, IL&FS, COVID, inflation shocks, Indian households have basically stress tested every macroeconomic textbook chapter in one decade. Yet spending hasn't vanished. Premium consumption, credit growth, vehicle demand and urban services are still holding up. The bigger story, if infrastructure spending, construction jobs and lower rates revive income growth, consumption could reawaken just as banks are finally healthy enough to lend cleanly. The world's youngest billionaires of 2026 are mostly in their early 20s. And between them, there were tens of billions of dollars before most people finished paying student loans. What stands out? Old money still matters, eyewear dynasties, industrial fortunes, inherited wealth, but AI has crashed the party hard. Several on this list built fortunes in AI software and online gaming, proving that in 2026, algorithms may be the fastest route from the dorm room to billionaire rankings. Also remarkable, this is a genuinely global list. Germany, Brazil, Italy, South Korea, the US capital is no longer concentrated in one geography or one industry. Promoters still control roughly 50% of India's equity market, while foreign institutions hold 16% and domestic mutual funds now own 11%. Retail investors just 9%, despite all the social media screenshots claiming everyone's suddenly Warren Buffett with a demat account. The big shift in domestic money quietly becoming more powerful. SIP flows and mutual funds are steadily reducing India's dependence on foreign capital tantrums. 10 years ago, FII sneezed and the market caught pneumonia. Now domestic investors at least bring tissues. But promoter dominance also means India remains a tightly controlled market where founders and families still call most of the shots.